This episode is brought to you by Persona. In fintech, one bad actor slipping through onboarding can cost you way more than a lost conversion. It can cost you your compliance standing. Persona gives you the identity verification infrastructure to catch fraud early, stay compliant, and still convert legitimate users without building it yourself. Fintech Takes listeners can claim a free year of access at withpersona.com/FTT. Hello, and welcome back to another episode of the Fintech Takes podcast. Today, I have a wonderful edition of Not Fintech Investment Advice with our friend Simon Taylor, author of Fintech Brain Food. As always, Simon had some very fun companies to chat with me about. We talked about accounts receivable. We talked about wealth management. I brought him some very fun sort of lending infrastructure companies that kind of broke his brain a little bit and that we were able to puzzle through in real time on our conversation. It was infused with AI, as everything is these days, but it wasn't just about AI. We also spent a little time at the end of the episode trying to continue to manifest more responsible behavior within the crypto ecosystem. We'll see if our pleas fall on deaf ears or if they, in fact, continue to move the industry in the right direction. As always, it was a delight to chat with Simon, and I can't wait for you to hear it. So here we go. Simon Taylor, Not Fintech Investment Advice. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, as always, we're joined by Simon Taylor for another episode of Not Fintech Investment Advice. Simon, good to see you, sir.
Good to see you, my friend. Good to be back podcasting with you. Had a nice little trip to Orlando. We were just talking about that before the show. How are you keeping, man? How was Fintech Meetup? I enjoyed your recap.
I appreciate that. It was good. We were at the Mandalay Bay, which is it's like dropping me into a different fishbowl, and I'm like lost. I don't know where to go and like what to do. So it was novel from that perspective. Always good to see people. Good to have lots of conversations. I will tell you, Simon, the number of people, particularly bankers, who are all in on like agentic AI, coding, building systems. I was actually blown away. It really surprised me. So the future is here, and we're living in it.
Yeah, I've never seen diffusion in enterprise like it. Like cloud adoption still hasn't really happened inside some of the mid-sized and smaller banks. AI adoption happened. It's gone. Like
it just
and like the engineering
else.
Side of it as well.
Yeah, it's wild. I mean, it's just like it's caught on in an almost viral capacity inside a lot of these organizations in a way that I've never seen something like it before. So it was all anyone could talk about. It felt like we were all sort of trying to impress some like omniscient AI hiring manager by describing like all the cool things we were building with AI. So it was a lot of fun. I imagine that AI might come up among the companies that we're going to talk about. As always,
there's a possibility.
Yeah, it feels like a chance. We each brought a couple of companies to the table. Simon, I will let you go first.
All right, the first one is Monk. This is an accounts receivable AI, and it helps companies get paid faster by ensuring invoices always go out on time, even if the contract is really complex. So you can drag and drop your customer contract into the platform and it'll figure out the invoicing schedule for you. It'll even email your customers for you. It will chase them for you. And it claims a 24% better response rate than human agents, which is quite nice.
Interesting.
And it does all of the reporting stuff you'd expect off the back of it. And what I liked about this, Alex, is accounts payable has kind of happened. There's so many spend management this, spend management that, but accounts receivable, as a small business trying to get paid, it's still stupidly hard.
Yeah.
So this is kind of that gap in the market. And there's some really nice bits of focus here, like focusing on the edge cases. They list on their website, like, well, let's say somebody's got a missing W-9. Maybe we should email them and ask for the W-9, check that it's correct, check that it's matches. On my personal favorite, the agents will set you up as a vendor inside of Ariba or Coupa or any of those god-awful procurement platforms, which if you could just do that for me, I will give you all my money. Totally. Because I've had to contract directly with banks before in past lives and beyond, and now as a podcaster and a small business, contracting with very big companies is unbelievably painful. So just have the agents do it. Wonderful, excellent, love this product. So big fan. What say you?
Well, that's a great question. I think it's really interesting. I mean, receivables finance as receivables automation as a category, particularly for AI, I think is really pretty powerful, right? I mean, I spend a lot of time these days talking about collections from a lending context, and receivables is just like collections for non-lenders, right? In a sense. And so it's like you're sending out these invoices, you're doing all the work to get paid. And I guess one thing, as you were talking about like navigating procurement systems and some of that stuff, is I do think one thing we forget a lot with payments of any kind, right? Any kind of payment is it's always an exercise in power, right? So one party has more leverage than the other, and as such gets to force that party to pay or be paid in the way that they want, right? And so as you were describing it, like if you're the big powerful company that has the leverage, well, then receivables is probably pretty standard for you, right? Like you can kind of dominate the other party in the contracting phase. You can set the terms for exactly how you want to get paid.
Yeah.
You can send the invoice. You can make them connect to whatever systems you want them to connect to. And it's probably not that painful. So you would look at a product like this and be like, I don't really know. But if the shoe's on the other foot and you're working with a counterparty that has more leverage and they get to set the terms, even if they're buying something from you, right? I think sometimes people are surprised by the idea that like, even though I'm the one selling something and someone else is the one buying something, the buyer can still have more power when it comes to the mechanics of how we're going to like conduct this transaction. And that's where
100%.
a lot of the pain comes in. That's where a lot of the like need for, let's call it diplomacy, comes in, right? Like how do you hassle a large counterparty that owes you money while still doing it in like a respectful way that doesn't like jeopardize future business? You know what I mean? Like there's a reason why you would want to have, it's almost like a lawyer for chasing bills. Like Alex Johnson respectfully requests that you pay this. Alex Johnson is happy to create an invoice that will match the contract and all of the things you're doing. Like I want someone acting on my behalf, working with sort of powerful counterparties that I need to get paid by. So I think particularly in that context, I really like this idea. I guess, Simon, a question I have for you is from a go-to-market perspective, what's the right place for this stuff to eventually live? You know what I mean? Because obviously, like we talk a lot on the show about, is this a product, feature, or company? And I'm curious, like, does this type of functionality, it makes a ton of sense. Does it eventually get absorbed into other systems? Do you see like spend management platforms jump onto the receivables side as well as the payment side? Like what do you see kind of this future space looking like?
Yeah, it's interesting. Ramp just launched Ramp for Startups, focusing on the smaller segment quite directly. And I would imagine that's where this would be really, really compelling. So there's no reason why you couldn't add this feature. And I do wonder about the direct go-to-market. Like, why would I know this product exists if I'm just running a mid-sized business or I'm accepting payments via Stripe or whatever? So there's channel partners could be really, really crucial. So who are all of those companies where people are getting paid today? So Stripe, Adyen, Shopify, all those guys, bake me into there as like a little be on that marketplace. And then who are all the other folks like the accounting software and platforms? Who are those channel partnerships? And channel partnerships is a muscle. Like some companies are really good at it and some companies less so. I was speaking to the founder of Meow a long time ago, and Brandon, and he said, like, we have grown pretty much off the back of our channel partnerships. Like, it's made us incredibly efficient as a business. And, if you don't have that direct go-to-market, if you don't have a big sales team, it can be a wedge. And I sort of think about that for this, but who knows? Maybe the pain is so great, everybody will have the same reaction I did when I saw it, which was like, oh my God, I want this. Can I click it? Oh no, it's not available in the UK. That's
right. Damn it. I think that's fair. I mean, and again, it goes back to like, who needs this the most, right? If you're a big, powerful company that can exercise a lot of control over accounts receivables, like, it's nice to have, but maybe not as like hair on fire problem. If you're a small business working with larger counterparties, I could see this being much more appealing. But of course, the challenge is, how do you get to all those small businesses? And
it's almost like Novo or Relay, those sort of like SMB focused neobanks. Those would probably be really good partners for you. That was something that was sort of tickling the back of my mind that I couldn't quite reach. They're almost the sweet spot here. And then I wonder about, like, it pains me to say it, but like, community banks and regionals, like, those banks surely have a lot of SMB customers that are trying to get paid. And this white labeled for them would look like whizzy bangy superpowered stuff that's an upsell, but their customers would love, right? Like, who doesn't want help getting paid?
No, it's funny you say that, because one of my sort of large scale theses for the next couple of years is that community banks are going to have to find a way to embed a lot of these whiz bang features in order to like differentiate the accounts they're delivering, right? I mean, like, if you're a community bank and you're trying to compete for small business operating accounts, but you're going up against like Capital One that now has Brex, or you're going up against Mercury, you're going up against whomever, like, you're going to need more tools in the toolbox. And I think that makes all the sense in the world. So it does feel like distribution is something that needs to go through partners, but I love the capability. Can I ask you one last question on this one?
Of course you can. Be my guest.
So, and this is like a larger question, but I think it applies here specifically. What is the answer that you're hearing these days that's most compelling from a startup perspective? If they were to go to like a bank and say, hey, we built this thing, for a bank not to come back and say, well, why can't we just build this with AI ourselves? What's the layer on top that a bank would be unable or unwilling to build themselves?
I think the nuance and the success rates, like the 24% better customer responses, the 90% of contracts are processed straight through. It's that performance. Like, anybody can build a prototype in AI. Heck, even I can do it. Like, it's so easy to do. It's stupidly easy. So of course the bank can build it. Like, the cost of building things is not the differentiator now. The cost of building things well in a way that performs, the difference is always going to come down to your performance. How much did you save? How much of a difference did it make? And like, I keep coming back to Ramp. The reason they're growing so fast is because they ship so fast and they're so methodically focused on those performance numbers. Like, when I interviewed Eric Glyman on the FinTech Brain Food podcast, he boiled Ramp down to his company equation. Like, they save customers time and money and we will get revenue. Like, it's as simple as that. And every page load, every workflow, they're like, can we remove this step? Can we remove this piece? And I'm yet to come across an internal bank delivery team that can even think that way, because of all of the other hurdles they have to deal with in order to get anything into production in the first place. They're much more concerned about, I need to get the budget in place, and I need to get through compliance, and I need sign-offs, and I need to keep all of this internal politics in great shape, and I need to know that a customer is going to buy it, versus I can buy this from a partner and I can sell it, and it will perform better if I do. So I would make the buy argument on this one, unless you feel like you can outperform them. So somebody like a Ramp, for instance, I would back them to potentially outperform it. They have a bigger data moat. but execution is in the details and the quality.
Yeah, that makes sense to me. Like this idea that we're going to maybe see over the next couple of years, a lot of people try to vibe code alternatives to things that they could buy and then realize that like they're spending so much time and energy trying to get that, because it's that last 10% where the performance sits and the value sits. And it's like you can get it to 90%, but that last 10% is devilishly hard. And it's like, that's the point where it's like, do we want to spend all our time trying to get that last 10% for this thing that's important, but isn't like the core of our business and what we do? Or do we want to just buy it from someone else? And I guess that's kind of
consider cybersecurity, right? Like Anthropic just announced Mythos, or, and Project Glasswing. They found security vulnerabilities in the most secure software on earth. What are they going to find in your little vibe coded app? Like it's kind of ridiculous how many if generating code is faster, then you're generating vulnerabilities faster. And do you really want to do that as a financial institution? And will all of your vendors have done that? Like that's a legitimate question too. Third party risk management starts to look very different in an age when every third party could have vulnerabilities exposed by AI. So I do think that cybersecurity dimension is a meaningful one as well.
Yeah, no, I think that's absolutely a great point. All right, Simon, can I give you my first company?
Please do. Let's roll.
Okay, so my first one is a company called MKIII, which is sort of styled as MK3. Okay.
So Mortal Kombat 3?
That's exactly what it looks like. So the gamer in you get it. MK3 is what it looks like. I think Mark III is technically how you say the name. So they are offering, basically, it's a very novel idea. It's embedded underwriting with model insurance. Okay. And so the basic idea is if you are a bank or credit union and you want to loan money to customers, but you are worried about being able to approve all the customers that you would want or be able to like take as much risk as you would want, instead of using your own underwriting model, you can use this underwriting model from Mark III. It gets embedded as an iframe that you just sort of drop into your digital lending workflow. So it just sort of sits within your existing environment. And it's an underwriting model, just like any other loan underwriting model. But the difference is that it comes packaged with insurance on the lending decisions. And so basically the idea is that you can approve more customers while taking less credit risk, because the credit risk, if the model doesn't perform as expected, right? So they set these thresholds for like, if there's model drift or the model doesn't perform and it leads to losses, those losses, meaning losses caused by the model not performing, are insured by a set of reinsurers that Mark III works with on the back end. So the theory is, hey, if you're really good as a lender, particularly like a community bank or a credit union, like you have relationships, you want to say yes, but underwriting and data-driven underwriting and machine learning and complex algorithms and all that stuff is not your bag. Embed this, and we will ensure the decisions, the lending quality, the decisions that this underwriting model is making. I have never seen anything like this. Obviously, like lending insurance is not a new concept. There's lots of folks out there that add like lending insurance as a thing on top of a loan. Sometimes it's something that you sell directly to a customer where it's like, hey,
but never
if you lose
insurance
your job,
for the underwriting of the model that the bank's using.
That's right. And it almost reminds me a little bit of, some of the products out there that will be like, hey, like fraud models and stuff. Like if you use this fraud model, will indemnify you for the losses on the fraud model. Like, so you see it on the fraud side occasionally, or in other places. Chargebacks is another one sometimes where you see like, oh, like you don't have to pay if we screw this up, we'll cover it. So it's basically like an expression of the confidence we have in our model. We're going to indemnify you for losses if they occur. That I've never seen that in credit risk. And so these guys are, I think, relatively new. They've started to develop some partnerships with specific, looks like mostly on the credit union side so
Mhm.
far. And I don't know, I'm intrigued. I think there's some challenges in terms of distribution and how you get connected to all the right sort of credit unions or other lenders who might be interested in this. And from a credit risk perspective, I'm always nervous when someone says, like, we've built a better model that we can outperform. And by the way, it's so good, we're willing to insure its performance. That always makes me nervous because lending is a business where you get your teeth kicked in. But I points for originality, at least in terms of like a model I've not seen before.
And that was going to be my question, which is like, okay, but what's this been back tested on? And how did you get that data? Because okay, if you've tested this on 20 years of data from 30 different financial institutions in, kind of different market segments, great. I'll take a look at that because at least it feels a bit more battle tested. But how did you get that data to back test it? Because most lending data is proprietary. It's not like markets data where you can just go back test a model on markets data and see what it would have done if it was performing in the 1970s, 80s, 90s, whatever conditions. That data doesn't exist for lending. It's only inside the bank somewhere. So how does the reinsurer know what they're insuring?
Well, this is a great question. So I don't know the answer. Looking at their website, it looks as though they say it's built on $3 billion worth of loan data over 20 years of performance. And so I think they have found a source for that data. It might be the credit bureaus, right? They have the back testing data sets. So they might be using the bureaus. To your point, I doubt it's proprietary like bank cash flow data or any of the things that like banks or other lenders are using more today. And so it's not going to be totally comprehensive. I will admit I am surprised that reinsurers like a Munich Re or someone like that would be interested in signing off on it. And so it makes me think that they've at least kicked the tires on the underwriting model and feel reasonably comfortable. Yeah. So
but then
it's
remember, people saw something in FTX. I mean, heck, I did, right? So you can be big wrong sometimes, but
oh, sure. Yeah.
It's part of the nature of the business. But what have they seen in it? It's really interesting. There's another thread running in my mind, which is we're speaking to NVIDIA a couple of days ago from the Tokenized podcast. And one of the things I didn't realize is they've been helping a lot of payments companies build what they call payments foundation models. And I'm PayPal, I'm Checkout, I'm whoever. And I definitely don't want to use one of the frontier lab models and send all my data to them. I'm very protective of my data. It's my moat, especially in the age of AI. But I do want to help my merchants get better loyalty, and I want to help, identify more fraud. I want all of the benefits of like a frontier level model. But, there are now open source models that are pretty close to frontier. So what NVIDIA will do is they'll custom train one for you that is, it's a transformer model to the payments companies. I haven't seen that yet in lending. But that would be really, really interesting. It's like if you had enough data about your customers, you could potentially start to build a genuine foundation model. So I don't know if Mark III has disclosed what type of like actual AI model is running under the hood. Is this classic machine learning here? Is this a transformer? Is it like a domain specific foundation model here? What are we looking at? I don't know if they disclose that anywhere, but it'd be interesting to see.
Yeah, not that I can tell. I mean, obviously, anyone you talk to today is going to say, "Oh, yeah, we're using LLMs. We're digging into like all the." Like, they're all going to say that, but like, to what degree is it true today versus how might LLMs and that technology sort of improve their model over time? Because I've heard the same thing, right?
Right, but there's a nuance here as well. Like, there's using an LLM to do the workflow around the data.
Yes, and versus then building an actual model.
Building a model from your account data and the credit data and the numbers, right? Because ultimately, what is an LLM? A large language model is just a set of vectors and embeddings linking the distance between words and sentences. You can do that same model of vectors and embeddings linking the distance between transactions and lending decisions. And if I use an LLM to help with my customer contact in front of the lending, that's a language model, but it's not a foundation model. And I think it's worth separating those two out because there's so much marketing in this space sometimes that it's important to separate it.
I totally agree. And what I've heard through the grapevine is that all big lenders, at least, are kicking around their own foundation model using lending data, using their own proprietary data. Like, we are going to build a lending foundation model, and we're going to see if it can outperform our sort of traditional homegrown underwriting models that we've built. I imagine that anyone who's in that business of trying to like outperform the market, essentially, which is kind of the offering here, right, is like, we can be smarter on underwriting than you can, and we can insure that risk. Would require them to do that. So I would be surprised if they weren't at least exploring the sort of lending foundation model concept that you describe. I will also say the other benefit to all of this is, and this is a very interesting one for banks and credit unions of different sizes, there's a lot of compliance challenges and sort of regulatory requirements that come on with loan losses, right? So there's stuff like, what are your capital requirements? What are your CECL obligations in terms of having to set aside reserves for future losses, all that kind of stuff. And I've actually talked to quite a few smaller banks and credit unions that are like, look, we'd love to lend more, but we're constrained because we have to set aside so much for losses. So one of the benefits of this is, if we can insure your losses within these parameters, we can actually offer you relief on the requirements that you're holding back, the reserves you're required to hold back. And that, I think, is another interesting thing because it turns lending for smaller banks and credit unions into less of a balance sheet business and more of like a transactional business in some ways. And so I think that that's the other.
That could be quite disruptive.
It really could, right? And it kind of leans into the idea of like, we have private credit and we have all these other sort of attributes. So as we see lending become more of like a multi-step manufacturing process with different providers at every level, rather than like vertically integrated the way that it used to be in the 1950s, I think that we will see more offerings where it's like, we can plug in here, we can insure this particular risk, and as such, we can offer relief to this person in the value chain. And so it kind of fits into that broader trend as well a little bit.
100% does. I love it when you educate me on the lending stuff, sir. It is my blind spot, it is my weakness, and it's always fascinating to learn more.
Well, that's why we're a good team. Simon, give me your second company.
Okay, second company is Wealth Architect, the AI financial planner. So it helps customers build financial plans by describing their dreams in natural language. For example, help me buy a home by 2028. Then it provides detailed plans, a bit like your RIAA would, and goals to help achieve that outcome with your little charts and all that kind of stuff. So you might need to save an extra $225 a month into your house pot. You might need to whatever. The plan can evolve over time, and it's fed by your transaction data, which it then cleanses so that you're not having to categorize everything yourself. It's just it's taking care of the busy work of having transactions. And what I think is neat about Wealth Architect is it's a bit more than a PFM. Like, they built multiple different agents for tax-aware planning. They'll do Monte Carlo stress testing of scenarios. So yes, there's a PFM in the middle of it, and yes, it's categorizing transactions, and yes, you're goal setting, but it's kind of a bit more like having a conversation with a wealth advisor where you're going, I kind of want to do this by then, and it's like, okay, here's your plan, and it'll kind of set the rest up. My only worry here is like 99.9% of people sit in front of a chatbot and don't know what to say, and the skill of a wealth manager is to pull that out of them, is to get to the bottom of it. Whereas if I'm just like sitting trying to do financial planning on an app inside of a chatbot, like, couldn't ChatGPT do this and create these charts? And like, what? Okay, it couldn't. It would struggle to do the Monte Carlo simulation, and it would probably struggle to connect to Plaid. But how long until Plaid is connected to all of these things natively? Like, really, how long is that? Is it days? Like, I wouldn't be surprised if by the time this episode comes out, it's already there. And that's the kind of thing where I love this product because I think it's the beginnings of the personal finance agent. Public.com has a personal finance agent, but it's baked into that product. And then Revolut, just today as we record this, announced their personal finance agent that will help you manage subscriptions, but it's stuck inside of Revolut. I think Cash App has one that's stuck inside a Cash App. And I was like, well, it needs to live outside of that and connect to everything else, doesn't it? It needs to be my personal finance agent. So I like what they're trying to do. I just wonder, how durable can they be? I'm just so battle scarred now by like, AI will never be able to do this. Oh, wait, it did it.
This episode is brought to you by Persona. Every fintech founder hits the same wall. You need to verify users, but off-the-shelf solutions aren't built for how your product works. Persona is the identity verification platform that puts you in control of your flows, with the automation and scalability to take you from your first 100 users to your first 1 million without replatforming. There's a reason that companies from YC-backed startups to publicly traded fintechs run on Persona. And right now, FinTech Takes listeners can claim a free full year through Persona's startup program at withpersona.com/FTT. That makes a lot of sense. First of all, great name, Wealth Architect. And I do.
Did you like it?
That
I thought it was a bit like. It's definitely Charles Schwab-y. It is. But I kind of want it to be like a bit more approachable. Maybe that's me, but like it's more like finance buddy. Like I'm your finance planner. I got you. Just something a bit more look.
No, that's interesting. I mean, that probably speaks to the fact, Simon, that you're a young soul at heart and I'm an old soul at heart, even though we're roughly the same age. So perhaps it's a question of who they're trying to market to in terms of the language they use. I will say, when I was looking it up as you were talking, there's another company called Wealth Architects with an S. Is a wealth management firm located in Silicon Valley that helps you design and execute a comprehensive financial plan without AI. And if you look at their website, it's much more even like beautiful house on a beach with waves crashing on the shore. We can help you with this. So it's like the more upscale version of it. And I guess that's what you get when you add an S to the end. So they might want to think about rebranding just to get away from that one. But I agree. I mean, I think, so first of all, the notion of just type in what you want and we can have a conversation about it that can lead to a set of recommendations.
Yeah.
That is very powerful, right? And I like the idea of a conversational interface on top of financial advising, planning, wealth management, PFM. Like, humans think in terms of natural language. And I think that's one of the reasons why, even though I'm a little skeptical on like agentic commerce as like a commerce thing. You just wrote a piece about this, actually. I am very bullish on agentic search already, right? Because people want to type in the language that they think in their brain. Like, we want to ask questions. We want to be able to phrase it the way it makes sense to us. We don't want to search in keywords. And I think a similar thing applies to financial advising. Like, the reason that financial advisors, human financial advisors, probably still are a pretty popular option if you have the money and the time to engage with them is you can just ramble to them. You can just ramble to a human. They'll listen. They'll parse what you're saying. They'll repeat it back to you. You'll go, yeah, that's what I meant. And they'll go, okay, that kind of means this. And they'll help you like with the translation layer between making financial decisions and you describing what you want. And to me, like, that's a big layer that humans have been the only interface between. And now we have LLMs that can do that probably better and certainly in a much more convenient fashion than talking to a human. So I think that part is great. And I will also say, as it distinguishes between like the Revoluts and Cash Apps and whatever's of the world, even public, I like the idea of one of these agents existing that's more focused on your long-term ambitions than like short-term. So like if it's Cash App, it's like, hey, am I going to be able to pay my bills next week? Hey, what about this specific transaction? Like, it's much more like day-to-day type stuff. There does need to be an interface, and maybe it doesn't belong in any of those neobank apps. Maybe it belongs in a separate place, or maybe it is something that a public or someone eventually sort of owns. But there does need to be a place that's more like, what are your long-term financial ambitions? And let me help you map that out. And I've focused in on this problem as it relates to like home ownership, where it's like, hey, I want to buy a home 8 years from now. And like nothing in fintech or banking is set up to help someone who wants to buy a home 8 years from now, right? Like everything is like, if you have a down payment and you want to buy a house next month, I can help you. But if you want to buy a house 8 years from now, like go away.
You go figure it
there
out.
needs to be, so there needs to be a go figure it out layer for people who are trying to responsibly like plan out the next 10 years or 20 years or 30 years. And not just retirement, by the way, like other goals that you might have during that period. So I like that as a frame. I will say, having said all of that, Plaid has already partnered with Perplexity to allow you to drop your financial data into Perplexity. We will see more of that, right? We will see more of data aggregation combined with chatbots and large language models just being kind of natively integrated shit. If you wanted to, you could ask Claude to go scrape your bank accounts today. And you could give it your bank account information and they could do it without having to go through a data aggregator, which is sort of the worst case nightmare scenario of the big banks that don't like open banking. But like, there's nothing stopping you from doing that. And so I guess to your point, the thing that's important here is how do you establish a brand and a sort of center of gravity as this is the place I go to have this conversation. And to me, that's almost as much of a like brand marketing, customer acquisition problem as it is a technology problem. Because like this is pretty par for the course in terms of like, I could have ChatGPT do this or Claude do this for me today, right now, without having to go through this provider. Why might I choose something other than Cash App, which I go into for my transactions, or Claude, which I use for just general questions? What's that middle category where it's like, we are the home for your wealth planning questions? And I don't know why Wealth Architect will deserve that title and that role versus someone else.
Yeah, I'm lost on exactly that too. Why isn't this just another PFM via another channel? And how do you get the consumer to choose you? Because PFM, like we know, there's a certain small subset who absolutely love it, and then there's everybody else. And the problem is not the people who use PFM, it's everybody else. So this is a feature inside something great, but we talked about that like center of gravity. It needs to exist outside it. And that's kind of what I was getting at with the brand. Like what gives this cut through? And I do think that sort of chime segment is actually the most underserved at this stuff and has the most to gain. In fact, Lauren Coldani from Acrew was an investor in NerdCon, and she had a few of the Chime folks come down to NerdCon talking about some of their early traction and how they did their go-to-market. And that's really resonating with me of like, consumer go-to-market is extremely hard. You have to be incredibly focused on it. The prize for succeeding is enormous, but it is really hard and you have to focus on it. And that's why when I look at the brand and I see Wealth Architect, I don't see something that's going to have consumer resonance. If you look at the Chime brand, it's extremely powerful and clear and crisp, and you absolutely get what the wedge is, and then you can buy the cross-sell and you can see how aggressive they've been to that brand promise throughout everything they do. They're aggressively low fee in a way that no other bank on earth is, not even in China. Like, it's nuts how low fee they are. So there's a gap in the market for something that's not monetizing payments necessarily, or trying to monetize the direct deposit ownership, but is monetizing a relationship with you and helping you get towards a different outcome without necessarily trying to collect all of your AUM either. Like, it's this third thing. And that's what you called, I think, the guardian agent, which I thought was a great term. And I think I need to pay for the agent, not the products that the agent selects, in order for it to be truly a guardian.
That's the other thing, is the business model here is tough, right? Because you like, on the one hand, from like an AUM perspective, great, but what if you're not the one who should be investing these funds? What if it's someone else? Like, if it's AUM, are you giving me the best advice on where to keep money? Maybe, maybe not. If it's offered by, someone who's selling products and kind of doing the like Credit Karma model, can I really trust this because you're getting paid when you refer me to other products? That's not really going to work. And actually, it's funny. Everyone in the PFM space has figured this out, right? All of the big PFMs that have gotten traction in the last 10 years, they all learned from Mint.com, and basically all of them do subscription as their business model. And what they've realized, which I think is kind of the key to winning in this space, is if you're getting paid for truly being trusted and unbiased, just like Wirecutter with the New York Times, like you have to get paid for that directly.
Yeah.
And that's the only way to really ensure full alignment with the customer. Now, I will say, I could see banks getting into this space as well, because banks have such complex multi-product, like cross-subsidization models, that they could offer something like this and probably be unbiased, because if you keep your deposits with them, then they can lend the deposits out, and like they have enough of a diversified business model that they could potentially offer something like this. But yeah, I would be worried about whomever, like a Credit Karma offering this, or someone whose business model sort of puts that objectivity into question.
Exactly.
Yeah. Yeah, no, but definitely interesting. It's a window, I think, into what future product experiences will look like in this space. Like, tell me what you want, and don't worry about trying to know how I think about it. You just tell me what you want the way you think about it. That to me seems very powerful. So I like that for sure.
And I'm liking at the moment in my own life, I'm certainly vibe coding around some edge cases. I'm a walking, talking edge case, right? So I have at least 5 operating Gmail accounts. So my expenses are a complete mess because I have accounts with different emails, and Ramp lets you forward from your personal email to directly to Ramp. But if you have 4 different personal emails, then that breaks. So how are you going to get those all to reconcile? And all different things land in different places at different times. So they launched a CLI, a command line interface. And what I did is I just built a little cron job that sweeps all of my email accounts, collects the receipts from those third party, like those other 3 emails, and submits them with a memo and checks it. Like, cool. That kind of stuff I can now just build. So sometimes it's about just releasing the tools to your the people who have the agency. And I suspect I really want every other financial institution I use to launch a CLI now, so that I can solve all of my own edge cases. And your personal finance agent should be a really great developer that can do this sort of stuff for you. And you should be willing to pay that really great developer to do that. And hopefully they are a bit more risk averse than I am, and kind of being willing to do some of this sort of stuff. That to me feels like where the Guardian agent is kind of going. It also really helped me with my taxes. Oh my God. Like I have my little Clawbot now. Every time an invoice goes out or every time I have a receipt, it's just storing those all in a folder ready for the tax season. It's all prepped. It's all ready to go. I'm vibe coding all of this stuff because it's that painful for me. And I can genuinely say this is the first tax season where AI actually helped me. Like it really did. But I had to custom build it. So, long may we find new things to do.
No, that is absolutely true. All right, Simon, let me give you my final company.
Let's go.
Which is, you'll like this one, CloutScore. So CLOUTSCORE, CloutScore. CloutScore turns digital income into real credit. So the concept is that it is a version, I suppose you could say, of cash flow underwriting, in that it will look at your cash flow patterns, your earning patterns, and distill that down into a score. In this case, it is the classic 300 to 850 score, using an analysis of more than 900 different data points. But the key is that those data points are sourced from digital platforms that people use to earn income. So places like Uber, Etsy, Shopify, OnlyFans, DoorDash, YouTube. If you make money as a gig worker or as a content creator or an influencer or any of those sort of new school digital economy jobs, CloutScore can take that data in and can distill it down into a score that is sort of indexed to sort of the classic credit risk prediction signals that lenders use, and then they can take that score and sort of use it as an input into their underwriting models. So the way that CloutScore sort of describes the problem here is that digital earners have a hard time earning credit because their income is fragmented across all these different platforms, right? No one just drives for Uber. They drive for Uber and Lyft, and they also have a little shop on Shopify where they sell something like digital earners tend to be very fragmented across lots of different platforms. The payout timing that they get is highly irregular, right? It can be weekly, monthly, per campaign, like just it's very irregular. It's not every 2 weeks. It's inconsistent. And so you don't always get like great documentation. There's no W-2s, there's no pay stubs. As you were just saying with like tax season and stuff, there's tons of 1099s. There's no like standardized income record. And, lenders are just very unused to it, right? They don't know how to parse sort of what it looks like. And so these guys have built a score to parse all of that data. My assumption is that it's all sort of consumer permissioned, right? And so much like a Plaid or an MX or what have you, you as the end borrower are kind of permissioning access to all of these different systems. It is reaching a little outside of where traditional sort of open banking has gone, right? It actually, in some cases, reminds me a little bit more of like Not and card switching, where it's like connect your Netflix account, connect your Amazon account. So it's reaching outside of like traditional banks.
Yeah, it's not just going for the cash data. Yeah, it's going to all of those other sources.
Right. And it's going direct, right? So like that's a good way of describing it is like if you go to the bank account, you might see income coming in from Shopify and Uber and whatever, but you're only getting like that one signal. You're not getting the full picture of what someone is doing on that platform. And it actually, the other thing it reminds me of is it reminds me of like the difference between small business lending, where you're just looking at the small business bank account, versus the type of small business lending that like Square does, where Square knows like inventory, sales patterns, marketing. Like Square knows everything about sellers on its platform beyond just the money that they're generating from Square. And then they underwrite that in like a very hyper specific way. And I think this kind of rhymes with that, where it's like, if we go directly to these end platforms people are using to earn money, we can underwrite them at a level of granularity and score them at a level of granularity that traditional cash flow underwriting can't do. Obviously, the bet here is that this becomes a bigger and bigger source of income for lots of folks. And, they have numbers on their website to that effect, right? They talk about the fact that 76 million Americans earn income outside traditional employment. There are 27 million full-time independent workers in the U.S. That's projected to be like 86 million by 2027. So they're sort of betting on this becoming a bigger and bigger trend. And I will say, just as a last note, when you like interview kids these days about like what the number one career is that they want, they all say content creators. So I don't necessarily want my kids to become content creators, but that is seemingly directionally where the puck is going. What do you think about this?
Well, the papa never wants the kid to do the same job, right? Like it's like I want you to do better than I did, youngster.
Right.
I get it.
You know what I'm talking about, yeah.
Yeah, I know how it goes. Look, I love it. Non-traditional data sources are now much easier to aggregate and scrape, so why not? And it's surprising how rich the extra metadata can be and how valuable that can be to lenders. The thing that I can't unsee from this is how obviously Claude Code built this website. And if it didn't, then it was probably Lovable or something else that did. Like, I see, because I cover 4 fintech companies a week, how many of them have the like single font, at the top where it's in white text and then it's in bluey purple greeny.
Yeah.
Like there's that multicolor.
Yeah.
And and then there's the same, like this looks like the default dashboard that Claude Code creates by default. Even the like why digital lenders can't underwrite high earners yet, it's fragmented. The font choices, the font sizing, like when you read a piece of writing and it's got an obsessive amount of isn't just and not. I'm like, okay, you used AI to do this, but you didn't go back and then edit it. Like, it's not a sin to use AI. It's a sin to like not have it be in your voice. And I think it's not a sin to use Claude Code. It's a sin to not do it. All of that is a complete tangent that has nothing to do with the quality of this business, because I do think that for lenders, everything right now is about how can I expand my borrower pool. Like they even say that on the exact website. But it is like how, when in the age of private credit, in the age of community banking, how can I get more business through the door? Am I just going to get acquired, or got to go out and acquiring somebody? Like, where's my growth coming from, and how do I compete with the big banks? This is a genuine option. And what is it? They even say on the website, 76 million Americans are earning outside traditional employment. How big's that number going to be in 3 years' time? 100 million?
It's exactly the question. And I will also say that this feels like directionally where cash flow underwriting and the Plaids of the world are going to have to go over time, right? Is to like continue to like widen the net of not just data that we can look at, but like reaching to the actual end source of the data. And so I would expect, I mean, I haven't talked to these guys, so I don't know, but like at what point will Uber object to sharing this data and want to be underwriting this themselves? Like when is that next generation of open banking fights going to happen? Will Plaid want to acquire a company like CloutScore to sort of increase all of this? I will also say, and this goes to your like total just like point off to the side, it brought me back to Clout, KLOUT. You remember that? The early days,
yeah, I do.
Where we all had
I
a
thought you were
CloutScore.
going with like social media score or something. I was like, cool. Can my Twitter followers get me better credit now?
Right. That's where my head went too, because you and I are old enough to remember Clout when it was in its heyday. But no, this is like Clout with a C, not Clout with a K, and a new spin on perhaps a more important idea over time as the American economy shifts in this direction. So interesting.
Indeed. Very interesting. So shall we manifest some stuff?
Yeah. What do you got for me?
I am manifesting no longer having to be the disappointed dad of crypto. Like, I don't know if you saw, but there was a drift hack. Another North Korea stole another $232 million of stablecoins last week. But if you follow it down the rabbit hole, the attack itself is remarkably sophisticated in terms of how they got the money. The problem was there was like about a 6-hour period where alerts had fired before anybody was able to pause these transfers from happening at Circle in this particular case. And part of the reason for that is there's a real worry, I think, in TradFi and in the crypto space that, like, well, unless there's a court order or unless there's a suspicious activity report, I'm not going to freeze anything. All I'm going to do is make sure I report this. And then if it really is, sort of comes from law enforcement or somewhere else that I have to freeze this, then I'll freeze it. And it's that sort of waiting to be told posture in compliance that just disappoints me. It's rational. I get you don't want to be sued, and it can go wrong, and it's a bad customer experience if you freeze things unintentionally. But it just feels really broken, and that was the spirit of manifesting for me. But in some good news, FinCEN has announced that they are now encouraging financial institutions to use machine learning, Gen AI, and blockchain analytics, and FIs will not incur additional risk solely for using those tools, and innovation in AML programs can weigh in the bank's favor during enforcement reviews. So the tide is turning. I hope that the industry gets this message. That is my manifesting for today. I will get off my soapbox.
No, that's good. As always, I appreciate your disappointed dad of crypto encouraging the industry to be better vibes. I will double down on that one and just say I very much agree. I think there's a chance that we're headed in a good direction on that because I have definitely noticed a lot of I don't know. I mean, crypto's so funny because it's like 4 different groups of people who've all been at the same party for a long time, but they're fundamentally different groups of people, right? And the serious folks who want to build and the hobbyists who want to play on the weekends, never had a problem with those folks. It's the people who want to earn a quick buck, who want to take shortcuts, who don't want to do the things that we do in TradFi for good reasons. And I think a lot of those people are getting sucked away to prediction markets, or they're chasing after some AI unicorn or whatever. And so I am starting to see some of those folks leave the party. And I was just at an event this week in North Dakota, of all places, where it was a bunch of banks and credit unions talking about crypto and stablecoins the whole time.
Yeah.
And so talk about like adults in the room and like a much more sort of serious approach. So I do think the character of the industry is changing a bit.
Oh, dramatically. I see that in my own professional life. It's unbelievable. I'm now having conversations with banks about where stablecoins actually help them specifically with displacing correspondent banking. And when you get into the nuances of like, maybe we use ISO messaging and we use Swift, you just don't use the correspondent banking system, and here's the specific messages you use. When you're at that level of depth, it's very grown up and it's very different.
And I would imagine for someone like you in particular, much more satisfying. So that is a good place to end it. Simon, thank you as always for hopping on. You're the man.
You're a star, sir. Appreciate you, and I'll see you soon.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.